Well, it's been a rough 24 hours for global investors, particularly the major tech companies. Denis Sahinovic joins us now from KOSEC for the latest. Thanks so much for joining us again, mate. Firstly, we've seen this broad sell-off in equity markets globally. Do you see our local market going a bit lower from here?
Yeah, we've seen quite a few days in the red over recent trading sessions on the ASX 300, ending the day about 0.8% lower. We also saw that Wall Street also fell overnight, with the Nasdaq down almost 4%, while the S&P 500 was down 2.8%. A lot of the downward pressure is coming from different macroeconomic factors, which are causing a lot of volatility in global markets at the moment, such as political tensions between Russia and Ukraine, COVID lockdowns across China, elevated inflation, also potential rate hikes, and also supply chain bottlenecks as well. At this point, it looks like we could stay quite range bound in the near future. However, breaking above the strong level of resistance formed around the 7,600 mark on our local market would be a massive confidence boost.
Now, Australian first quarter CPI data was released today. What did you see here?
Yeah, we saw that headline inflation surged to 5.1% in the first quarter, which is the highest annual level in almost 21 years, and also well above market expectations as well. It was the largest annual increase since the 6.1% gain in the June quarter of 2001. And we also saw that underlying inflation, which tends to be the RBA's preferred metric, lifted 3.7%, which is quite a bit above the target band of 2 to 3%. Consequently, we did see that bond traders are pricing in a stronger likelihood of rate hikes in May or June, with one-year Australian Treasuries jumping 2 basis points. And also leading economists have renewed calls for May rate hikes, indicating that we could see rates jumping sooner rather than later.
And just finally, US bank stocks seem to be underperforming over recent times. What's causing the downward pressure?
Yeah, we've seen that US bank stocks are currently looking like they could potentially have the worst monthly performance since the COVID crash of March 2020, with the S&P 500 Banks Index down 9.2% so far this month, erasing about 120 billion US dollars in market value. A lot of the downwards pressures come as a result of the combination of high inflation and a potential elevation in rates. And this is despite a lot of the financial institutions failing to gain a bit of a boost upon solid first quarter earnings. The majority of US banks seem to be lagging behind the broader index at the moment, on a growing realization that the current risk of a potential recession outweighs the growth in the margins that they could potentially receive as a result of higher borrowing costs.
Certainly interesting times when it comes to the markets. We'll keep watching closely. Denis, thank you for your insight once again.
Thanks, Adrian.